is Elliot again, and welcome to part 2 of our capital structure lecture. So in part 1, we discussed the concept of operating leverage versus financial leverage. In financial leverage, we're discussing the impact of financing a company with debt on the earnings before interest and tax, or the return on equity, as well as the return on total assets. In this class, we are going to take this further and discuss capital structure, specifically looking at financing a business with either debt or equity, and whether this would have an impact on the overall value of a company. So when you look at equity, what normally constitutes equity? So we've got our share capital, reserves, and outside shareholders' interest, as well to a certain extent deferred taxation, is part of what we call equity finance. Then debt looks at long-term liabilities, interest-bearing debt, and any other permanent portion of other current liabilities. So this is what we are going to consider in our discussion of the company's capital structure, focusing on its debt and equity. So now the question is, should companies have optimal capital structures or a preferred optimal capital structure which theoretically maximizes on the company's value? So the question is, what is the debt to equity ratio that results in the lowest weighted average cost of capital? Why are we worried about the lowest WACC? Because the higher the WACC, it means the higher the return expected by providers of capital, which increases the risk profile of the business. So to maximize on a company's value, we would want to have the lowest weighted average cost of capital as possible. So the question is, do we have an optimal capital structure that can result in a company achieving the lowest possible WACC? But if you look at other theories, specifically the Modiglian and Miller, the M&M theory, they postulate that capital structure is irrelevant in determining a company's value. So they are saying whether or not you finance a company by, let's say, 100% debt or 60 to 40% debt to equity, it's not going to have an implication on the value of a company. But this they made looking at the following assumptions. There are no taxes, there are no transaction costs, no costs associated with financial distress, no agent costs, no different the cost of borrowing for individuals and companies. But I'm sure as you are looking at these assumptions, they are highly theoretical, because practically businesses have to pay taxes. Any financing decision, business have to take into account transaction costs. And cost of borrowings between individuals and companies are definitely different. Then, so what is the principle here? We normally say, from the M&M theory, they say assets determine the value of the company and not how the assets are financed. So these are the posture of saying how we finance a company will not affect the value of the business, because it's the assets that generate returns that should then ideally determine the returns, the value placed on a business. So in the M&M theory, the measurement of value should be net operating income capitalized at WACC. We are going to discuss further. So in summary, the M&M theory says case 1, no taxes or insolvent costs. So it means we are not worried about the capital structure. That is no optimal capital structure. Then case 2, there are corporate taxes but no insolvency costs. Therefore, optimal capital structure is 100% debt. But remember, why would debt then be preferred? Because the cost of debt is a tax deductible expense. Therefore, because of that tax advantage, it may be preferred to finance the entire capital through debt. And then each additional dollar of debt increases the cash flow of the firm. Then case 3, we've got corporate taxes and insolvency case. What are we now bringing to the table? We are saying because of the financial leverage risk that comes with financing a business with debt, it definitely increases the risk of defaulting on those payments, which may then result in the company being insolvent. So what then would be the preferred capital structure? We now need part debt and part equity to negate the risk that comes from entirely financing with debt. So this occurs where the benefit from every additional dollar of debt is just offset by the increase in expected insolvency costs. Then the tax benefit is only important if the firm has got a large tax liability. Then another key thing that comes through from the M&M theory is the risk of financial distress. So the greater the risk of financial distress, the less debt will be optimal for the firm. So let's say, for example, if a business is having cash flow challenges, having debt financing can be a big problem. Why? Because the interest payments as well as the capital repayments are obligatory. And normal debt funders do not care whether or not the company is under financial distress. They want their interest payments, they want their capital repaid. So in that event, debt will be less optimal for the firm. And also the cost of financial distress can vary from business to business. As a manager, you need to understand the cost of your industry. Okay, so let's now look at capital structure, focus on what is called the trade-off theory. So the trade-off theory can be termed a revised version of the M&M theory. Why? Because they are saying when you look at the assumptions underlying the M&M theory, they are not realistic. Because if you look at a practical world, there are taxes, there's a cost of financial distress plus transaction costs. So from the M&M theory, the trade-off theory more or less borrows from the case 3 that we discussed previously. So what does the trade-off theory say? It says, as you increase debt on your balance sheet or as part of your capital structure, there's also an increase around the cost of that debt. So you're saying the advantage of getting debt finance can then be offset by higher interest rates. So let's look at this example. I've got a company which is financed 100% by debt and a company which is financed 50% by debt. When provider of debt companies are looking at the risk profile of the business, their chances are high, they are going to charge higher interest to a company with 100% debt financing. Why? Because it has got a higher financial risk as compared to a company with 50% debt financing. So the trade-off theory then says the more you continue to accumulate debt, the benefit of debt financing is then offset by the higher interest charges, which can result in potential bankruptcy. Then another theory that is also postulated as far as capital structure is concerned is what is called the pecking order theory. How does this work? So this assumes that there's no target capital structure. And normally how we raise our capital, we follow a preferred hierarchy, which is number one, definitely we want to use our retained earnings if these are taken as the most prepared form of financing. And normally the cheapest. There are no transactional costs, ETCs, money that we've generated in-house. And if you want to reinvest in the business, there are no additional costs that comes with that financing. Then we can go to issue of debt. Why? Because of its tax advantages. And then maybe we can issue convertible debt and preference shares. And then finally, we can consider financing via equity. So it means as part of the decision-making process, a business will then look at this pecking order rather than looking at its capital structure. Because if you have got the capital structure, they are saying you want to maintain a debt equity ratio of 3:1. That will then determine how you raise additional capital. But in the pecking order, we are saying we are not worried about the debt to equity ratio. We are just saying, do we have the retained earnings to reinvest? If we have, that's our first port of call as far as our capital needs are concerned. If we've exhausted our retained earnings, our next item would be issuing of debt or raising loans. If we've exhausted that, we can then go to preference shares. And finally, we can then look at raising new equity. Again, I'm sure in principle, the pecking order theory is saying, don't worry about the capital structure. Have the preferred ordering of your capital. So what does this mean? Retained earnings have no control implications or compliance issue. It's our money already existing in the business, so it's very easy to convert or to reinvest. Then if you go to debt, it will result in non-governance and reporting to lenders and less ability to raise financing in the future. So saying why retained earnings are preferred. If you are going to raise capital via equity, it may dilute the control of existing shareholders, and you also mean greater market scrutiny if you bring more shareholders on board. Then also, if you look at the pecking order, why equity is sitting right at the bottom, ordinarily management are reluctant to raise capital via equity if ordinary shares are perceived to be underpriced. Then we've looked at these various theories. So let's now analyze the sources of financing. So we've got retained earnings. So agents' costs of high levels of retained earnings. So remember where the agent's cost is coming from. So we're looking at management, we're looking at shareholders. Normally shareholders would want their return in the form of dividends. And on the other hand, management would want to retain the earnings to finance future projects. So the question is, whose needs will carry the day? So that's what we mean by agent's costs. And also if you look at if management are sitting on high levels of retained earnings, they can end up making suboptimal decision to the needs of the shareholders due to lacks of checks and balances. Then if you look at debt, normal costs to be low cost and tax deductible, but debt normally suits those companies with stable cash flows. Why? Because of those contractual payments which need to be made. And then we look at convertible debt. It converts the debt into equity at present ratios. But normally you'd find that conversion is given the option of the holder of the debt instruments, and they'll normally convert if the performance of the equity instruments is good. That is, let's say they are told to convert debt every $1 to $2 worth of shares, and then the value of the equity has been going over time. So it needs to be attractive for the debt holder to convert to equity. Then if you look at raising capital via equity, it can result in dilution of shareholding and may be something fall in the share price, especially if you are looking at listed companies. And also at times, raising finance using equity can be an advantage to the companies. Management may have inside information as to the true value of the equity of a company. So they can be able to raise more equity, maybe where in the case where the share is undervalued. Okay, so financial leverage versus a firm's weighted average cost of capital and its equity beta. So the question is, remember our CAPM formula, beta. Does beta take into account financial leverage? So it's always useful to know how much of the beta is impacted by financial leverage. So as a concept, beta measures the systematic risk facing an industry or a company. And you find that systematic risk is affected by the financial leverage of the business. So remember when you looked at when you did the lecture on cost of capital, we discussed the concept of unlevering and levering this beta. Effectively, what were we doing there? We were adjusting the beta to the different levels of financial leverage affecting businesses. So if you look at the Hamada formula, levering the beta and unlevering the beta, we are taking into account the debt to equity ratios, which may differ between two entities. So a simple example, A Limited is an equity beta of 1.1, a debt to equity ratio of 50%. The risk-free rate is 8%, market risk premium is 8%, company cost of debt is 10%, tax rate 28%. And the company which is to change its debt to equity ratio to 150%. So the question is, what impact will increasing the debt to equity ratio have on the company firm's beta and ultimately its weighted average cost of capital? So the current beta is based on the debt to equity ratio of 50%, which is the one. So for us to calculate the new beta, if we change our capital, our debt to equity ratio, we have to unlever the current beta and relever the beta using the Hamada formula, and to get a relevered beta of 1.68. Why is it going up? because of the increase in our debt to equity ratio. We are now carrying more debt on our books as compared to previously. So more on capital structure. So the theories on capital structure are not intended to be applied rigidly, because in practice, companies take into account a whole lot of different factors in determining their capital structure. Maybe the company will need to look at its tax situation. Based on its tax situation, it may be good to raise more debt as compared to equity. Why? It has accumulated a huge amount of assessed losses. We may need to look at the business risk profile of the business, the control. Are shareholders willing to dilute their control via a new share issue? The growth rate of the company, whether the company is a target capital structure or not. So you can find that a company may be willing to raise more capital via debt, even if it's got more retained earnings. Why? Because they want to adjust their capital structure in order to meet their target capital structure. And you can also see some short-term deviations from target capital structure. A company has got immediate financing needs, and they know maybe doing an equity issue may take more time versus the immediate needs required from that capital. So we introduce the concept of agent costs. A normal agent cost is what we call, there may be a conflict between shareholders and bondholders. What bondholders think is good for the company and what shareholders think is good for themselves. But ultimately, these two capital providers, they are worried about returns to themselves. So because of their different needs and their different forms of financing, it may create some conflicts which we are going to discuss. So as an example, if you look at bondholders versus shareholders investing in high-risk projects, you can find that, let's say a company is struggling and is sitting in negative equity. Shareholders may be more willing to invest in high-risk projects as compared to bondholders. Why? Because as shareholders, they know that if this project comes through, at least they are going to get a return on their investment at no additional cost. But for the bondholders, a high-risk project, if it fails, it may mean that the company then fail to pay them their interest as well as the capital portion. So you find that when a company is under financial distress, the risk appetite of these funders may differ. Shareholders saying the company is already struggling, so it's either I lose everything or at least I try something to salvage a bit of return for my investment. But bondholders still saying, if this company can still be able to pay me back my interest and capital contribution, I can at least salvage something, which is where we can then come up with the conflict between the bondholders and the shareholders. Okay, another concept is running off with the money. So shareholders can know that this company is now hitting a dead end. They can advocate for more dividend payment. So effectively, they are cashing out of the business. But bondholders may be worried about the tenure of their loan to say, can the company still survive for the next 10 years to be able to repay its obligations depending on the tenure of the loans? Or a company is under financial distress. Shareholders may see no point in further investing in this company or in rescuing this business. Why? Because they are not guaranteed that if they put in additional money, they will be able to get a return. But bondholders would be saying, guys, this company is facing financial distress. Shareholders, can you pump in more money to rescue the business? Which can then result in conflict. Playing for time. Shareholders may be prone to say the company is struggling. Let's just try to do a bit of firefighting. Maybe there may be some change in the economic situation of the operating environment, which can then see the company come back to its glorious days, which may not ultimately come. Then changing the capital structure of the firm. So we found that in most cases, bondholders can put some loan cover and say a company should maintain this type of capital structure. Why? So as to protect their interests arising from these agent costs. But I encourage you to further read in your prescribed textbook on the further details around these agent costs that can come through between shareholders and bondholders. So some of the mechanics that are normally used to manage conflicts between bondholders and shareholders, the use of loan covenants. Then examples of loan covenants, I would want you to research more on some type of loan covenant that can be used by bondholders to protect their interests as part of managing these conflicts. So lastly, from an exam technique, please note, no one size fits all capital structure. It depends on a number of things. And when you look at the theories of capital structures, we say they should not be applied rigidly, but they are only giving you a starting point or some form of guidance as entities determine their own individual capital structure. So if you are asked to comment on a company's capital structure, please consider all the other relevant information in the case studies. Why has a company chosen this capital structure and not the other one? What other information have I been given which may have influenced the company's decision to follow a certain trajectory as far as its capital structure is concerned? So for additional reading, please go to chapter 14 in Carlos Korea, read further on the capital structure and the theories around capital structure. So for any further questions on this lecture recording, please feel free to contact the math department on the details given there. Plus remember, don't look at the capital structure in isolation. I'm sure we saw how the capital structure affected the calculation of the weighted average cost of capital. So it may mean that you are going to be examined on capital structure indirectly when you are doing a question which requires you to determine an entity's weighted average cost of capital. So never look at these topics in isolation, but always look at them in combination. Once again, thank you for taking time to watch this lecture and pleasure reading. Thank you.